Hi, I'm Dave Schiller, Senior Partner at City Captial Financial Planning. We do get asked lots of questions, but some of the more frequently asked ones are as follows. I've got spare capital. What should I do with it? Should I pay off my mortgage or pay down my mortgage? What's the best thing to do with that money? Well, that question comes up a lot. And in truth, if you have a mortgage that, as far as you're concerned, is way too high or is out of control in terms of the levels of debt that you have, then certainly from a peace of mind, there's nothing wrong with paying that down or paying part of it down to a level that's more comfortable for you. But we are obsessed by clearing debt in this country, and I understand why. However, one thing about investing your money instead of clearing some of that debt or all of that debt is if you invest it for the future and you sit on your hands and let it grow, you would hope, and this is down to your own personal levels of risk, that that money will be sufficient to pay off the mortgage in years to come and give you even more money on top of that by way of long-term savings. Of course, if you clear your mortgage down, once you've cleared it down, that capital's gone. You won't get it back again unless you remortgage. And then some lenders, depending on your situation in life, might not give you that money back out of the property for your everyday spending that you might want it for. Something's for sure is if you put it into an investment portfolio that's structured correctly for you, it could be daily liquid. Therefore, you could cash in part or all of at any time, probably with a week or 10-day turnaround to get the money back to you. So actually, to tie it up into property, your capital up into property by paying down the mortgage, in my opinion, is not the best idea when you've got the opportunity to have more flexibility within a diverse investment portfolio. Should I do a pension or should I do an ISA? No, I don't actually think it's one or the other as an answer. I think a pension should be viewed as a long-term investment strategy. You can't get your hands on your money till 55, the earliest anyway. Depending on how old you are, of course, it's always good to start early. The benefits of a pension are that you get tax relief on contributions, you get tax-free growth, and you get a tax-free lump sum of 25% of the fund value when you get to retirement age, 55 being the earliest. An ISA, well, you can put 20,000 a year into an ISA. It's tax-free investing. You get no tax relief at source, but it is tax-free investing. The benefit of an ISA is that you can get your hands on that money at any time you need it. And it's daily liquid, should be daily liquid. So as a either or, I don't think it's an either or. I think it's you should do some of one and some of the other. Seek advice, speak to an advisor. Look at your affordability. But I certainly think long-term planning and medium-term planning is a good idea. What can I do with my cash ISA? Well, that's a question we get a lot these days with interest rates being as low as they are. A lot of people have made savings, they've built up savings, and they maybe build up savings in their bank account, but also in a cash ISA. And the problem is with cash returns being 1% or less, well, with inflation headlining above 2%, normally between 2 and 3%, you're losing money in the long term. Your money is actually negative by -1 or -2%, depending on inflation, if you're only getting a 1% return. So how do you go about maybe investing that money? Well, you can actually transfer that cash ISA to an investment ISA, and you hold on to the ISA tax umbrella that it has, and you don't have to break that valuable benefit of tax-free savings. So you could effectively switch your cash ISA to an investment ISA to grow that portfolio, hopefully within your own personal attitude to risk, which of course you should discuss with your financial advisor. I've got 3 or 4 different pension schemes, having worked at different organizations over all the years of my working life. I don't know what I've got in them. I don't know how the money's invested. What should I do? Well, certainly as advisors, our job is to help you through that minefield. Pensions are a minefield these days. And what we would do is write off with your authority to all the different pension providers, get all the facts and figures and technical information behind those pensions as to, for example, how's the money invested, what options are there in terms of maybe changing investment funds, what are the charges, are there any exit penalties, are there any guarantees, and actually looking at the whole strategy of what you have in place already against potentially consolidating your pensions into one easy manageable pot. The benefit of doing something like that would be a single investment approach that suits your own personal attitude to risk, would be a consolidation of charges, so there'll be all charges in one place. Of course, you'd have an advisor and looking after you and a fund manager, hopefully investing the money suitably for you. And when it comes to actually wanting the money out, i.e. 55 onwards, requiring an income, it's all in one place. It makes it very easy to draw down and take your tax-free cash. So the concept of a consolidation exercise is something you may want to consider if you have various pension pots. I hope this was useful. Thank you very much.